Okay, so we're going to try to explain distributions, which is, in my opinion, one of the most difficult concepts to grasp in terms of commercial banking, just because it gets very confusing, both in terms of just thinking about how you can calculate whether money is leaving or coming into the company, but then with all the different signs and the different accounts, it can get confusing. But hopefully, we do a good job here of laying a strong foundation for you to understand this. And of course, if you don't grasp it right off the bat, don't feel stressed or concerned because it's something that comes with practice. But hopefully, I'm helping you look at it in the right way so that when you do try your hand at some of these, it will come easier to you. So there's a lot of subject matter on the slide here, but it is an analogy. We're going to start off with an analogy, and then we're going to kind of transition into the actual statements. So by now, of course, you know that this is an application of the balance sheet, but it will also use the income statement in some way. There's different line items on the balance sheet and the income statement that are fundamentally tied to each other. And you're going to see that it's not something that's easily explained, but once you work on it, sometimes you discover things, and it ends up being very interesting. So, okay, so let's get started. What is a distribution? A distribution essentially, very simply, is we're trying to figure out how much money has left the company, okay, to some other company, some related party or its shareholders, just by way of transfer. Okay, so sometimes a company will give one of the companies related to it. Let's say you have a company and then your mom has a company, and your mom's company is not doing well. So she's like, "Can you help me out with 100,000?" So if you through your company transfer $100,000 to your mom's company, that's a distribution. Okay, and we're going to cover it, but that's the gist of it. We're trying to figure out how much money has either left or come in to the company through by using its statements. So here, this is a stock image. We're going to assume that you're the guy in the glasses, okay, and then your friend is Joe. Um, so let's start from the top here. Let's say in scenario one, all right, um, we have kind of in statement format. So we have 2024 and 2025, and then these numbers are basically the amount that Joe owes you. Like you guys are buddies, you know. Sometimes you lend Joe money, sometimes Joe lends you money. All right. So, and the way that you keep tabs is you have a little slip and you write down at the end of each year how much money you guys owe each other. Okay. So here's slip number one. The amount that Joe owes you, we can call it due from Joe. Due from means owed by Joe, right? Um, so in 2024, Joe owed you $50,000, and in 2025, he owes you $100,000 now. So just pause for a moment and think about this. If from last year to this year, Joe now owes you 50,000 more dollars, what does that mean? What happened with the cash? So, if you can just take a moment to think about that, I think you might be able to come to the conclusion that you have loaned Joe another $50,000. So in the beginning of 2024, he already owes you 50,000. That means at some point over the past however many years, you've lent Joe 50 grand. And through the last year, you've loaned him another $50,000. So that's the only thing we're trying to figure out. We know that $50,000 must have left your bank account to Joe, because if you lent him $50,000, you need to have the $50,000 to like go out of your account in cash, right? So this is a distribution from you to Joe, okay, based on this IOU slip that says how much Joe owes you because it went up. That means that you lent him $50,000, which means cash went out of your account. Okay, hopefully that makes sense. And then let's see IOU slip number 2. So this is an IOU slip in the other direction. This is how much you owe Joe. I know it's kind of confusing. It's like you guys are friends. Why don't you just keep one slip and then you work off one slip? But when it comes to companies, they keep separate slips. So this slip is actually an asset because anytime someone owes you something, it's almost like you made a loan to them and you can expect it back in the future. That's actually an asset, okay? And then when you owe somebody else, that's kind of like you having a loan. That's actually a liability. So this is, of course, is an analogy. And I think if I were to keep an IOU with my friend, I would just have one running account, right? I wouldn't separate it into two. But for the purpose of this analogy and transfer it into the actual statement, we keep separate tabs. So here you owe Joe, which is due to Joe. Okay. So in 2024, you owe Joe $50,000. And in 2025, you now owe Joe $25,000. So what happened in that year? Well, you owe Joe less, which means that you paid off some of your debt to Joe. So you paid him $25,000 because the amount of your IOU decreased, or the amount of your debt to Joe decreased by $25,000. How can it decrease? Well, you have to have paid him back. So then this represents another outflow of cash from your account. So by now, after 1 and 2, we're down $75,000 this year. Okay. And then number 3, the final kind of distribution that can happen is called a dividend. And in this scenario, we're just going to say it's if you were this guy with the glasses, it's your wife's allowance. And we'll call it a dividend to wife. Okay. And this stuff down here will just show you how the dividend works. Okay. So we're going to kind of run through almost an income statement. So this is how much you earned after deducting all of your operating cost or your living expenses, the stuff that you need. So your earnings is $100,000. You got to pay your taxes, $25,000 in taxes, and that's being kind of soft. We're in Canada, so in reality, you would eat probably 30+% of that in taxes. But let's just say it's 25%, and then you end up with a net income of $75,000, which is the after-tax earnings, right? Also called net income. So let's say that at the beginning of the year in 2024, your savings account had $200,000, right? So if you made $75,000 after tax, that money would technically go into your savings account. So at this point, you would have $275,000. Okay, but then you decide, hey, I'm going to give my wife some money, some allowance. We can call it a dividend because, you're a good husband. So you subtract $50,000 after all of the taxes have been taken, all the costs have been taken. This is the final net income amount plus the amount you actually have in your savings account. In the actual statement, this is called the retained earnings, okay, for the balance sheet. So then once you give your wife another $50,000, this comes straight out of your bank account again, then your savings account will only have $225,000 left. So you're going to see that the total distributions for you over this hypothetical scenario is $125,000. Okay, so the distributions, we're going to use D for distributions, is going to be everything that happened over the year. Okay, so $125,000. That is the distributions. Okay, so let's apply this to the actual statement. All right, so coming off of the last slide, this slide really just tells you, remember how we split it into 1, 2, and 3? This is what you can expect to see on the balance sheet / income statement. So the asset, the due from, you're gonna see a line item on the balance sheet under the assets. Okay, it could be current assets or non-current assets, but you're gonna see something called due from, and it could be called anything. It could be called related parties, due from related parties. This could go in the blank, or shareholders could go in the blank, or some number company name could go in the blank. Okay, any of these could go in this blank, but it's going to mean the same thing. It means that some other party owes your company some amount. Okay, and then on the liability side, like we just covered with that analogy, you're going to have due to, and any of these could go in the blank again. Related parties, shareholders, or the actual company name. And it could be current or non-current liabilities too. So wherever you find this in the balance sheet, assets or liabilities, it's going to actually be presented the same way I just showed you, okay, with you and Joe. And then the dividends comes out of retained earnings, but you can find this in the income statement, because the reason is because you want to see it at the very end after you know how much your company has made in net income, because that net income is going to go into the retained earnings on the balance sheet. Okay. And then, but if you pay a dividend and there isn't, here's the big thing. The company might not always have this. This isn't always the case. Okay. A company could not pay. There's a chance they could not have any distributions over the year. They could choose to not have any distributions, or they could choose not to give any dividends. For example, you could choose to give your wife an allowance of 0. That's a choice. So don't expect to always find it, but when you do find it, know that there's a distribution. Okay. So the dividends, you can see it on the income statement. Now I'm going to pause here and again have an aside for you. I don't have a slide for this, but just keep in mind that these distributions here, there's another place that's easier to figure out. Instead of us doing all the math, there is just a straight up the answer or a value for it in the cash flow statement, which we haven't covered yet, but it'll just literally list distributions to related parties and it'll tell you what that number is. But at the mid-market level, not all companies will give you a cash flow statement, so you need to know how to calculate it from just the income statement and balance sheet. Okay. All right, so let's move on to the next slide. It's really fast. Hopefully, if I did a good job teaching you through the analogy, the next slide should all make sense to you and all come together. All right, so you're going to have to deal with a lot of my bad handwriting here, but I have laid out the income statement. Again, here's the income statement, but we've added a little piece at the bottom, and this is just showing you the beginning of the year retained earnings, end of the year retained earnings. Remember in the analogy, we called that our savings account, okay? And then the dividends declared, we can think of it as that allowance to our wife, okay? And then in the balance sheet, you're going to find an account that reads like this, okay? It doesn't matter if it says related parties or due to shareholders. The key word is the due from or the due to, okay? So we're going to figure out distributions here. And what I like to do is, first of all, let's just do the easy part. Dividends. Dividends is just whatever it says. We're going to calculate for 2025. So in 2025, dividends straight up, you know that you're giving out $25,000, okay? So what dividends actually are is they are after you've, made your net income for the year, it's the company's director's decision to pay out some of the earnings to its shareholders. So like if you're the only shareholder, which sometimes is the case for small businesses and commercial businesses, if you're the only shareholder, you own 100% of the company, then it's really you just paying yourself $25,000 extra, right? Depends if any of the salary up here is also being paid to yourself. But it's a way for for you to extract money out of the business into your own account if you're a business owner. So that's the most easy distribution part is the dividends. Okay. Next, we're going to look in the balance sheet and we're going to find due from related parties. So remember, due from means just from the words due from, it means like another company owes your company money. So that amount, 60,000. So another company owed you, or let's say Joe owed you $60,000 in 2024, and then they owe you $50,000 in 2025. So that means Joe actually paid you back $10,000. So here, this is actually money coming in. So we're going to do a plus, okay? Money coming into the company, because distributions isn't always money going out. It could be money coming in. So this is $10,000 from Joe, or in this case, from a related party. It's not always going to tell you what related party it is. And that's where the notes to the financial statement sometimes come in handy, because it'll tell you who that related party is. Okay, but that's just something to cover later. And then down here we have due to shareholders. This is how much you owe the shareholders, or your company or this company owes its shareholders. Or you can think of it as the amount that you owe Joe. So last year, the company owed $23,000, and this year they owed nothing. So just think about it. I like to just think about it instead of writing a formula for it. But because it's due to and the amount that you owe somebody went from 23,000 to zero, it means you must have paid it off, right? So this is money going out of your company because you paid off a loan, or you paid off whatever amount you owe the shareholders. So these are the three amounts. And then if we add them all up, so this is 48,000, so it's 30 plus 10,000. So overall, the net distributions is $38,000 going out of the company. Okay. So hopefully that makes sense because we did the first slide. Conceptually, it's challenging. There's a lot of different signs. You could use a formula when it comes to the due from or due to accounts, but I think if you just understand, due from means that somebody owes you, due to means that you owe somebody, and then look at how the amounts changed, I think it's an easier way to figure out the right answer. Okay. So you might be wondering at this point, like all of this amount here, 38,000 is for 2025. Could we figure out the distribution for 2024 if we didn't have a cash flow statement that just tells us what it is? Well, no, because you need to know how it changed from one year to the other. So if you wanted to figure out the distribution for 2024, you need to get your hands on the statement for the year ended, not 2025, but December 31st, 2024, because then you can see what the balance was in 2023. Okay, hopefully that makes sense. But if you have any questions, please just reach out. Happy to explain it in a way that might suit your learning style better.